Welcome to Commotion Labs, Fundamentals for Startups. I'm Ashley Esteban, Associate Director of Commotion Labs. While we wait for everyone to join us, I'll make a few announcements. Next week, Hope Cochran and Elisa LaCava from Madrona Venture Group will present how to raise venture capital as a fintech startup. All of our Fundamentals for Startup presentations are archived on our Commotion website under Innovation Training Videos. We have covered a variety of topics over the past several years, so if you find yourself with some free time, check out our past talks. For our full schedule and to register for Fundamentals, please visit bit.ly/Commotion Fundamentals. Also, please subscribe to our YouTube channel and click the bell. You'll be notified of all of our future live streams. Fundamentals for Startups is funded in part by a grant from the Economic Development Agency. We will be dropping a link in the chat to a short survey. Please tell us who you are, where you're watching, and how you heard about this event. This will help us report back to continue the funding. Alicia Dalasi, who you will meet in a few minutes, is my co-host today. This month, we are proud to partner with BECU to support Fundamentals for Startups program. See how BECU, Washington's largest not-for-profit credit union, is helping grow the fintech community and inspire innovation in the Pacific Northwest.
On behalf of BECU, welcome to Fundamentals for Startups, the FinTech series. I'm Alicia Dalesi, Digital Innovation Specialist at BECU. BECU is uniquely focused on offering long-term solutions to support the financial well-being of our members and communities, and our partnership with Commotion helps us do that. Emerging technologies have the potential to both benefit and disrupt our members' sense of security and control, and we're committed to being at the forefront of innovation in the financial services space. BECU has partnered with Commotion over the last 3 years to support the growth in fintech in the Puget Sound area. To date, we've supported 11 fintech startups through the BECU FinTech Incubator and offered grants through the fintech track of the Commotion Innovation Gap Fund. We've learned so much through this collaboration, and if you're interested in joining the next fintech cohort, applications are open now. This month, we're proud to contribute speakers to the Fundamentals for Startup FinTech series, which kicks off today and continues each Friday in January. We really hope that you enjoy these speakers. Today, Gilad Bernstein is here to present FinTech, DeFi, Super Apps, and Aggregation, how these came together to power the correct FinTech revolution. Gilad Bernstein's an Israeli-born entrepreneur based in Seattle. Gilad began his entrepreneurial career early, and while at the University of Washington, he was involved in several startups, including serving as VP of Business Development at Watch to Help, which is a social cause and marketing platform company. After college, Gilad was a consultant at PwC prior to funding Utrip, an artificial intelligence startup that he led for 7 years as CEO. Gilad was honored by Focusrite and named their class of 35 under 35, and was awarded GeekWire's Seattle Young Entrepreneur of the Year award. Today, Gilad leads Brook Bay Capital, a small fund doing early-stage venture investing. He's also a board director and corporate advisor to numerous technology startups and large adventures adopting AI or personalization in the US, Israel, the UK, Australia, and others. Gilad is proud to be a startup advisor and CEO mentor through a number of leading incubators and accelerators in the US and beyond. Gilad will take questions via chat, so feel free to ask questions throughout the presentation, and I'll now turn it over to Gilad.
Thank you very much. It is great to be with all of you today. I wish I was there in person, but hopefully we can do that next time. So to kick off the winter speaker series, what I'm going to try to do is I'm going to try to give you a high-level macro view of the fintech explosion that we're currently living through, and to highlight a few of the forces that underlie that explosion in the fintech markets. But before we jump in, a little bit about myself. I'm an Israeli-born entrepreneur, UW alum, technology enthusiast. I'm a startup investor, and I'm a founder and entrepreneur. So I started by stating that we are currently living through an unmatched explosion in the field of financial technology, or fintech. But what makes me say that? Well, first off, we saw over $134 billion invested in the fintech sector in 2021, making it the leading sector for venture investment in the United States last year. Additionally, according to Forbes, we've seen that the investment in the fintech space has doubled or nearly doubled each of the last 3 years. We saw in Q3 a 173% increase in the fintech funding as compared to the year before. We saw over 100 mega deals. These are investments of over $100 million, excuse me, a 250% increase. The US is leading the pack, and there are currently over 118 unicorns in the fintech space alone. On this slide, you can see a graphic put together by CB Insights, highlighting their top 250 fintech startups of 2021. It's hard to see the individual companies, but try to focus on the categories instead. This highlights the expansion of fintech technology throughout the traditional financial markets. But the thing is, this chart represents only the traditional finance sphere. One key element of the explosion we're currently experiencing is that fintech is taking over other segments of the economy as well. But just to take a look, there's so much activity happening, even just within the traditional sphere, before we even talk about any other industries or sectors. So before we dive in, I think it's helpful to define some terms to make sure we're all on the same page. My goal in defining these terms is to be as broad as possible so we can be inclusive as possible of all the different ways that the sector is changing based on this technology. So you'll see these definitions be quite broad. So let's start with the basics. I find the definition offered by Investopedia to be spot on. The term financial technology, or fintech, is used to describe technology and technological applications that seek to improve and automate the delivery and use of financial services. Or said a little more plainly, fintech is just another way to describe the technology we use to save, invest, and manage our money. Pretty straightforward. Next, we have DeFi, or decentralized finance. I don't love many of the publicly available definitions of DeFi because I find that they are often too heavily reliant on specific technologies, usually the blockchain. So I like to define DeFi more broadly and in a technology agnostic manner. So DeFi is the name of a category of products, services, and financial instruments that do not rely on intermediaries, traditional banks, brokerages, or exchanges to be able to be sold or utilized. Or said another way, a way to organize our financial system around a decentralized philosophy. That's what people mean when they're talking about DeFi. The term Web3 or Web 3.0 refers to a future state of technology where the web is rebuilt around a foundation of crypto and blockchain technology. This is much more specific than the definition of DeFi. There's plenty of debate about whether Web3 is just a branding event, the future of the fintech sector, or a whole new internet that's going to take over everything. To me, it seems unknowable at this point, but to those who claim that Web3 is a whole new internet, I ask, what can a Web3 version of a company like Zoom or Dropbox or YouTube or Airbnb do that those companies can't already do in the Web 2.0 version where they are? Next, we have super apps. And Super App is a digital application that provides multiple seemingly unrelated services via a single application. Successful super apps aim to simplify and to unify the user experience, almost always including payments or financial transactions at their core. Said another way, super apps effectively become an all-encompassing, self-contained commerce and communication platform that embraces many aspects of people's personal and commercial lives. And lastly, we have aggregation theory. Now, I could speak about aggregation theory for an hour and only scratch the surface, so I'm going to do my very best to describe it in just 2 or 3 minutes at a high level. Aggregation theory is a theory that describes how power dynamics have completely changed due to the advent of the internet and mobile technology. Ben Thompson, the father of aggregation theory, said, "The best aggregators win, but providing the best experience, which earns them the most customers, which attracts the most suppliers or partners, which enhances the user experience further in a virtuous cycle." This is why aggregators win, and I'll give you more information on who they are in a second, but they win because they focus on consumer experiences. And by having great consumer experiences, they get the demand of those consumers and can wield that demand to have incredible amounts of market power. In the past, there was a time when the consumer's point of view might not have mattered quite so much. It used to be the case that success depended on controlling supply of a good or service, like cash or debt, or by owning the distribution channel through which these goods or services flowed, like branches. The difference with the internet is that goods and services can reach anyone, and distribution is free. And in markets where supply is plentiful, value accrues to the companies that own demand. That is, those that have the most end users thanks to their superior user experience. Ben calls those aggregators. And aggregation theory works because it serves everyone in the ecosystem. For consumers, aggregation theory works because consumer value creation is prioritized about everything else. Customer experience trumps all other decisions, and customer value grows exponentially as the aggregator gets more power. For suppliers and ecosystems, this works because ultimately aggregators are where the customer is. And of course, that's the single most important thing for any business. Additionally, aggregation theory works for suppliers and ecosystems because it provides them with a lot of things that they couldn't actually do on their own or could not do to the same extent on their own without the help of an aggregator. So things like making it easier to reach consumers, reducing your time to value, removing the number of gatekeepers in your way, and all sorts of the various things that the aggregator can do for suppliers in the ecosystem. And because both suppliers and consumers win, we give more and more power to these aggregators. And to finish, we'll take a lesson on aggregation theory from Taylor Swift. Honestly, Taylor made this argument for aggregation theory as well as I could have. How is it, she asked, that pretty simple code earns valuations that far outstrip the real world companies that actually provide the goods or service in questions? And she, of course, answered the question by saying, the answer is by consolidating demand at a scale that was never previously possible. Now, ultimately, just to finish this, to give you some examples, aggregators are the companies you interact with most often on the web. It's Google, it's Netflix, it's Facebook, it's Amazon, it's Airbnb, it's YouTube, it's Uber, it's Spotify, and there are many others examples. But if you think about it, you'll notice that while their businesses are completely different, the thing they have in common, the reason they have such market power is because consumers go to them in order to access an entire universe of options on the other side of the equation. Okay, so now that the definitions are out of the way, let's jump in. There are 3 key trends powering the explosion we're currently seeing. Understanding and utilizing these trends is a key way that many fintech startups achieve funding and success. The first is DeFi, decentralized finance, in traditional finance markets. Next is financialization of everything, or financial productization of everything, taking on other sectors, like I mentioned before. And third are super apps that use aggregation to own consumer attention. So let's see what these look like in the real world. We'll begin with DeFi. The first example under the power of DeFi are neobanks. This chart from TechCrunch highlights just some of the leading neobanks out there in the world. The basic idea is that neobanks no longer need billions of dollars in deposits, nor branches on every corner to be able to serve specific types of customers in a better way than some of the large existing institutions do. Because of decentralized technology, these banks can launch cheaper, quicker, and more easily, and thus be much more focused on a specific type of customer as opposed to having to try to serve the entire community at large. One specific example is a company I'm an investor in called Lance. Lance is a neobank focused on high-wage freelancers. Think CPAs, engineers, designers, and the like. And because of its nimble size and its freedom from the so many other things that the large banks have to worry about and focus on, Lance can focus on things that really matter to that specific user base. For example, like saving for self-employment taxes, which is very important to most freelancers. All the basic services of a traditional bank, backed by traditional banks to allow Lance to access the global financial system, neobanks can focus on customer service and customer experience as opposed to all the back-end things that the large institutions must do. This is one of the reasons decentralized finance has allowed for thousands of neobanks to launch all over the world. The next example is a local startup called Remitly that you'll hear from in a couple of weeks. As a startup, it was able to piggyback on the existing financial system and to offer its services without the needs for branches and all the other overhead needed by a company like TransUnion. This enables Remitly to pass those savings onto its customers, dramatically reducing the fee structure, and to invest in exceptional customer service, which some of the money transfer companies before had been lacking. Venmo, especially before its acquisition by PayPal, is a perfect example of DeFi. Venmo's users kept the same bank accounts they had before at the same banks and used the same systems they had before, and Venmo just added a layer on top. As we all found out, this layer, the ability to transfer money from peer to peer, was not a nice to have feature, but exactly what consumers were looking for, which is why Venmo took over the market so quickly. One of the main advantages Venmo had is that they were dealing with significantly fewer regulations and related overhead than the big banks due to the limited scope of their size, their cash on hand, and the limited number of services they're offering consumers. The next example is Selfbook, another company I'm on the board of. Selfbook is essentially trying to be Stripe in the travel industry. Similar to other companies we've discussed, Selfbook did not need to build out an entire new payments infrastructure, but was able to piggyback on what was already out there, and by doing so focuses on convenience and ease for consumers, which is ultimately what consumers want, and that leads to increased revenue and increased conversion rates, which is what their clients want. Yet again, instead of having to focus on building out a massive banking or payment technology platform, Selfbook focused on things that really count to its specific customers. And lastly, we have the buy now, pay later, or BNPL revolution that we're seeing across the board. BNPL is only a slight variation on an age-old offering called layaway that many retailers have offered for over a century now. The customer started by paying up front and got to take the product home once the product was fully paid for with layaway. However, data and technology have enabled a new type of offering, BNPL, which allows a customer to take the product home today and to pay back over a period of time. It's technology and risk assessment that allows them to do that and give you the product to the customer right away. Now, the next category I'm going to focus on is financialization of everything. So while DeFi, most of the examples focused on new ways to do things within the existing financial markets, the other reason, or one of the other reasons we're seeing such an explosion in the fintech market is because of financialization of everything. Fintech products moving out of the financial markets into other markets. So let's go and look at a few examples. The first example is a company called Hopper. Hopper is a travel company. They create content and tools to help travelers plan trips and then book those inventory. So why are they here? If you actually look closely, what you'll find out is that while they're a travel company, a vast majority of their revenue is actually made from financial products they sell their customers throughout the process of planning a trip. A few examples. They have a price freeze feature where you can pay a small price to have the price frozen for a few days for you to make a decision. That sounds a lot like buying an option. A price drop guarantee is like buying a hedge on the valuation of an asset. Cancel for any reason is transaction insurance. Flight disruption guarantee is another type of insurance product. As you can see, this 12-year-old company makes most of its money by selling financial products, and I can tell you this was certainly not their plan when they launched in 2010. The next example is another local startup that I'm a small investor in called Plonk. Plunk is a straight up prop tech company. They help homeowners manage and upgrade their homes. It's prop tech. But if you look at how they actually monetize their business, here again, it's all about financial products powered by financial technology. Plunk's Vanguard product is a home equity line of credit that uses the future value of your home as calculated by their technology as the collateral for the home equity line of credit, as opposed to using historical value or the purchase price of your home, making the upgrade cheaper and more available for consumers. Another example is Noble, another travel company I'm an advisor to. Noble is a member-only luxury travel club. They curate, recommend, and help travelers book travel. So why are they here? Well, as you can probably guess, Noble is on this list because one of the primary ways they make money is through financial products and travel. Their most successful product yet is a certificate that a customer can buy, which appreciates over time and enables that person to spend that increased value at a given property within a given time frame, which to me sounds a lot like buying a bond. Buy now, pay later fits into multiple categories. And as you will see, a number of these companies fit into multiple categories because it's always great to build your startup around multiple macro themes going on in the market. The reason I wanted to mention BNPL again is the fact that consumers are demonstrating that they like this offering and demanding that it comes into every other aspect of their lives, completely outside of their financial transactions, which is why you're seeing so many businesses adopting this payment product across the board. And lastly, and this is a great transition from the second trend into the third trend, we are seeing money transfer move into the social world. We're seeing Facebook and Snap and all sorts of other companies begin to integrate payments and money transfer applications into their platforms because they see the value of bringing fintech into the social sphere. Our last macro trend is the emergence of super apps. Almost all of them built around a payment platform. So we'll start by looking at some global players. Likely the most recognizable super app in the world is China's WeChat. My friend Zyke Daikwal, who is one of the leading researchers and analysts on millennials in China, says that WeChat is China's operating system, which is quite a strong statement to make. Due to time constraint, I'm not going to go into detail about the differences between each of these super apps, but the thing to keep in mind is this. All of these super apps are built around three core pillars: communications, commerce, and payments. And as we look for companies in the future that might be trying to become super apps, these are the types of things we should be looking for. So when it comes to the US, we don't really have any real super apps out there now, but we do have a number of attempts. The current market leader, I think, in an attempt to become a super app is Amazon and Alexa. In the past, eBay put together a conglomerate with eBay, PayPal, and Decide.com, which was a past attempt at building a super app. Facebook is a super app of sorts, but most of us still don't conduct a lot of business or commerce on there. So I sort of put them in the sort of super app category. And I'm sure you guys have heard lots of speculations about other companies trying to put together super apps in the United States. The recent example I read about was Block, formerly Square, considering the acquisition of Twitter or Pinterest or both to create a commerce, communication, and payments super app. Now, beneath these three macro trends that we just discussed, there are three enabling forces, which are providing a lot of information and a lot of power to push these trends forwards. These are AI and data, aggregation theory, and monopolies at scale. I'll finish by diving into each of these to provide some context into how these are applying within the current trends that we just talked about. So first, we have AI, data, BI, and more. So the first is truly big data and training data at scale are now available. You no longer need to already operate a large financial institution in order to have the data to be able to make these decisions and be able to do so wisely. So big data provides the ability to assess risk and probability without the need to already be a mega player at scale to be able to do so with accuracy. Next are neural networks at scale. Fast, cheap, global, and configurable neural networks enable this data to be utilized in real time and for any sort of information, whether it's market information, customer-specific information, or institutional information, to be integrated into that knowledge in real time to make sure that the decisions, the offers, the recommendations that these engines make are accurate and timely. Next, we have the explosion of BI analytics. BI analytics enable both machines and humans to act quickly and with much lower risk of making catastrophic mistakes. This means that these organizations can move much faster and provide service to their customers much more quickly than the traditional institutions can when they need to go through a traditional underwriting or similar process. Next, we have the rise in intelligent agents. And you're going to hear from FinAI in a couple of weeks, which is a great example of an intelligent agent company. And what intelligent agents are is that it means that you no longer need to have a massive staff or a network of branches to participate in the financial industry. And it means that trust can be built much more quickly, which I'll get to in just one second. Lastly, the thing about intelligent agents means that your offering can be available 24/7, 365. There can always be someone there to support your customer, which of course is harder to do at a traditional institution. And lastly, we have automated trust. Automated trust ultimately utilizes AI plus other things like ratings, peer-to-peer networks, identity and background verification, and all sorts of other information to build automated trust without the need for a person-to-person relationship or for a lengthy courtship relationship between the bank and the potential customer. Automated trust is something we've seen in other industries as well, Airbnb and Uber being two great examples of that, but automated trust is coming into the financial sector as well in a big way. Next, we have the force of aggregation theory. And I already shared a little bit about aggregation theory before, and I'm happy to answer a few questions in a few minutes here about it as well. But the force of aggregation theory makes it so that new startups in the fintech space no longer need billions of dollars in deposits or massive networks to become meaningful players in the fintech space. All they need is customer demand. And then your service can go and partner with all the organizations offering decentralized technology and everything else to be able to offer their services. But the power that these companies have comes from consumer demand. Lastly, we have monopolies. The bigger is better mentality, along with the centrality of payments in the emergence of super apps, powered by aggregation theory, is fueling an era of bigger is better. Regardless of what you think about this from a social policy perspective, this trend, along with the two others we discussed, is driving a proliferation in the fintech markets and pushing fintech technology outside of the traditional spheres and into every other sector of the economy. And ultimately, the reason why this era of bigger is better is sticking is because what we're seeing is that modern monopolies seem to benefit consumers, at least in the short term. They're great for shareholders. The tech and data they have works better at scales and thus incentivizes companies to become bigger. And economies of scales are easier to protect than ever before because of the scale of these companies. So these four elements together are pushing us in the direction of monopolies and bigger is better. And that is something that is good for the financial sector because we need data to power anything we do within the fintech space. Now, ultimately, all of these things come together. We have AI and data, aggregation theory, and monopolies, which are some of the forces that are impacting DeFi, financialization of everything, and super apps, which are some of the key trends that we're seeing in the market. And by utilizing these forces and these trends, many fintech startups have successfully launched, raised capital, and grow their businesses. And as we talked about at the beginning, made fintech the most invested market of any of the venture markets last year. Now, ultimately, if you are starting a fintech company or work at a fintech startup, how do you win? A few thoughts. Remember to focus on delighting customers and aggregating consumer demand. That is ultimately the most critical thing you can do for any business, but especially a fintech business, because if you have demand, everything else will come together. Next is you must push for accuracy from your models. This accuracy will enable you to monetize faster because you're not going to have to wait as long to test your models, to test your underwriting. You'll be able to offer your service to the public much faster, and you'll be able to price based on value delivered. You guys have seen a bunch of different pricing models across startups, but the best pricing model is always about value delivered. You price for value delivered, not cost incurred. So by having really good estimates for the value you're creating for your customers, you can use a better pricing model that better aligns your incentives with your customers' incentives, which of course, that alignment is going to lead to even faster growth. Lean into automated trust because it reduces your risk and supercharges customer growth and customer adoption. And lastly, remember, fractional ownership and digital scarcity will change the world. These are not topics I spent any time really talking about today, but these are really important things to think about for any company in the financial space, specifically the concept of digital scarcity, which we're going to see a lot more of in the coming years. Now, ultimately, these trends and these technology are all coming together to lead to a whole new world of possibilities in the financial markets, and I'm excited for all of you to take advantage of that. So thank you very much, and we have plenty of time for thoughts and questions.
Thank you for that, Gilad. That was really interesting, and I'm really excited to kind of dive into these questions and kind of see where that leads us. So if we're just going to jump right in here, one question that came up is, how do existing companies utilize this technology today?
Yeah, that's a really good question. And I think there's two ways that every company should think about utilizing any technology, the ones we've talked about today or others as well. And that's always a combination of testing internally and partnering externally. So if you're a larger institution where ultimately adopting new technology is difficult and there's backlog of engineering requirements and needs and all those kinds of things, the fastest way to do it is to pilot with startups. And as we know, there are hundreds and hundreds of startups in the fintech space to be partnered with. And of course, Seattle is a great fintech market on its own. So one way is to figure out how can you pilot, how can you partner and work with startups in this space in order to do this? And how can you create a sandbox or a part in your digital environment where you can test things really easily without having to go through a lengthy security, legal, data audit review, which of course will be necessary before you integrate these startups into your overall ecosystem. The second thing is to do what you guys are already doing, is to have people thinking full time about how to utilize technology. How do we test things internally? How do we partner with incubators and accelerators and other organizations to even learn about what's possible out there? But I think the most important thing I always say to companies is always test and learn. Test and learn is the best way to adopt any new type of technology.
Awesome, thank you for that. Another question we have from Brian is, do you see regulatory changes on the horizon which might I'm going to say this wrong, disintermediate traditional consumer banking? Laws regarding wire transfers, cash access, EFT, ACH are one reason that retail banks and credit unions exist.
Yeah, that is a question that I really have no answer to. It's a really good and a really difficult question. Will we see more regulation of this space? I think the answer is ultimately yes. Will it be transformative regulation? My gut says no, just because of the division we all know we have in DC right now. But this is a really good and a really difficult question.
We're trying to stump you is what's happening.
Yeah, no, this is a good one. I mean, it's really hard to predict what the government's going to do. But ultimately, the thing to remember is that aggregation theory and democracy actually work really well together, because it's ultimately about pleasing the consumer, pleasing the voter. So I would think a lot about, regardless of where regulation goes specifically, I would think a lot about what are consumers asking for, because ultimately in the short or medium term, regulation will shape itself to support the needs and desires of consumers.
Awesome. Another question we have from Daniel says, the Fed says that FedNow, their ACH replacement model on India's UPI, will launch next year. Won't that have big implications for many fintech ventures?
Absolutely, absolutely. I mean, and it would be a great thing for the DeFi space, right? Companies using the decentralized infrastructure out there in order to offer their services. This is going to be a total boom for them. So that's a really exciting thing that, well, we'll have to see how it's implemented, but I think will likely be a very exciting update that we see.
Awesome. And then from, and I'm sorry, I'm going to say this wrong, Sheng Wei it says, how do DeFi companies operate if they run their business fully on blockchain? They can operate globally without registration. Also, how can they manage their income tax if they take crypto?
Oh my goodness, that is a really difficult question. I'm actually an investor in a company that tries to help companies that accept crypto as payment from their customers to figure out how to do that. One of the key strategies I've seen used out there is essentially trying to hedge. So if you are getting X percentage of your income in a cryptocurrency, trying to figure out how to have X percentage of your expenses also in cryptocurrency so that ultimately you do not suffer from any sort of currency fluctuation or currency hedging risk that's out there. Now, in terms of actually paying taxes, this is really difficult. The IRS has put out a few regulations and specifications about how to account for crypto, specifically when buying and selling crypto. But when crypto is coming in as revenue, and then you have both the appreciation or depreciation of the currency along with the actual operation of the business, that is not yet clear. But what I recommend is that you, of course, keep really good records of all of your basis information, the cost at which you bought these, or the value, the fair market value of these currencies when they were given to you, because it's very likely the IRS will use some sort of mark to market or some sort of way of essentially pegging these cryptocurrencies to the US dollar to determine tax liability.
Interesting. Sounds like there's going to be a lot more to come as things develop from there.
100%. I mean, the exciting thing about being in, whether it's crypto, whether it's in just DeFi or any of these spaces, is that it is the early days. This is the opportunity for people, for innovators to really think about what are new ways of doing things. And ultimately, because regulation always lacks, the more we can innovate now, the more we can see what is ultimately good for our community and good for consumers, the more influence we're going to have once Congress gets really serious about regulating this space. I think it's a great time for people to be exploring both crypto itself, but also all the other applications that blockchain provides. And I quickly referenced this in my last slide. Let's see if I can easily get back there. In my last slide about fractional ownership and digital scarcity. This is something that really will change the world, right? We all know that before the blockchain technology, there really was no way to have digital scarcity. Once a piece of content, once something was created, it could be duplicated an infinite number of times, not only without any consequence, without even the knowledge of the people who were creating the original assets. So ultimately, the idea of digital scarcity, which I'm, like the rest of you, really a novice in working to understand, there's no question in my mind that this really will change the world. So anything you can do to try to understand the space will set you up really well as these things become more mainstream.
Awesome. Another question that we have is, can you explain how to prevent plagiarism and redundancy for digital scarcity? Basically, how can people prove they actually own the digital assets they claim to have?
Yeah, so again, you're gonna have to talk to, I'll do my best. You're gonna have to talk to someone who's a much deeper blockchain expert than I am. But ultimately, right, the blockchain is a decentralized ledger, right? It's a ledger of accounts, like who owns what or how much money is in a given account, et cetera, that is decentralized. I mean, lots and lots of people have a copy of it. And because lots and lots of people have a copy of it, if one person decides to cheat or to lie, then the rest of the community can come together and essentially say, nope, this is the accurate version of the ledger. So ultimately, the beginning of it is having every one of these assets logged into a blockchain of some kind that logs all the information about that asset, when it was created, where it was created, and most importantly, who owns that asset. And the thing that's important to remember is, right, if we use an NFT as an example of anything, a picture of anything, right, the owner owns the right to the original of it, but copies can still be made, but those copies are not original. And we can think about that a little bit like physical art. Obviously, it's not the perfect analogy because physical art can be harder to replicate and can lose more of its aesthetic value when being copied. But the thing is, ultimately, right, many of us have pictures or drawings or images of the Mona Lisa, but the Mona Lisa is only owned by one person, and none of us have any question of who owns it because they have physical possession. In this case, it's the Louvre, physical possession of the Mona Lisa. Instead of physical possession, you're going to be able to prove ownership through that blockchain, through that ledger. And there's a lot of questions about, how difficult would it really be to cheat or to manipulate the ledger? The answer is pretty darn difficult, but ultimately when there's enough money at stake, someone will figure that out, which is why there's lots and lots of engineers working to figure out how to create safer and safer blockchains and how to make sure that more and more people have a copy of the blockchain without increasing the effort or cost or technology need to actually validate a transaction, which of course is one of the issues the different blockchains have, the speed and effort at which it takes to validate a transaction.
Awesome, thank you for that. And then last question that we have for you is, how do you think banks and credit unions can keep up with fintech startups?
Yeah, so I think the most important thing is to partner. Ultimately, even the big banks, but especially smaller banks and credit unions, are never going to have the huge technological staffs that whether the enormous global banks or the large tech companies are going to have. So ultimately, I think the answer is true here, like it would be in any other industry. It's about partnering. It's about finding the right technologies and the right startups to be able to partner with to build that future together iteratively, step by step, as opposed to trying to do it all in one big whack by creating some sort of end vision or big vision of where it's going to go. And since we have just a couple more minutes, I did want to quickly touch back on aggregation theory. And just to say, for any of your businesses, whether in fintech or otherwise, that are thinking that where consumers are the end user, either you touch them directly or you enable someone else to touch them directly, I would really recommend that you spend some time reading some of the essays put out by Ben Thompson about aggregation theory. It's something that really has completely changed the power dynamics in our economy, in our market, and swung the power much more towards aggregators, much more towards those people who control demand, where in the past, where it was about supply. In the past, whoever had the store on the corner was going to be the person who sold you whatever was there, and they controlled it. They controlled the market because they controlled the access. They had the building on the corner, and they controlled supply. There was nowhere for you to get your toilet paper or your bananas or whatever from somewhere else. The internet has completely changed this, and this is true, just as true in fintech and financial markets as it is in any other market. So ultimately, if your business in any way touches consumers, I would really recommend that you spend some time getting familiar with aggregation theory and how that power can really supercharge your business and get your partners to align under your terms as opposed to having to bend to their whims.
Awesome.
So thank you. This was a pleasure to speak with all of you, and feel free to add me on LinkedIn if you have any more questions. I'm happy to answer them after the fact.
Yeah, we did have a couple of extra questions come in since we do have just a little bit more time. So one question from Michael came in, said, why do you include communication along with the commerce and payments as key capability for super apps? Do you simply mean chat?
Yeah, that's a great question. And chat is absolutely communication. I think chat is a great tool of communication. But ultimately, if you think about super apps, we think about WeChat, right? The most successful super app in the world. I don't have the stats in front of me, but the average consumer in China spends hours per day on WeChat. Hours and hours and hours per day on WeChat. And ultimately, that means when it comes time to make a transaction, to buy something, to transfer money, whatever, they're already in the WeChat experience, they're already in the WeChat app. Now, ultimately, commerce is not enough, because even for Amazon, which obviously is coming closer and closer to this in the United States, but you don't spend time hanging out in the Amazon app. You don't meet friends on the Amazon app. It doesn't give you, entertainment value like the other apps do. So ultimately, if you are on Facebook or Twitter or wherever you're hanging out and you decide something to buy, you have to switch, you have to leave that application and go into Amazon and find whatever you're looking for. Ultimately, one of the reasons I think we're going to see these social apps, the big ones try to build super apps around themselves, and the small ones likely to be acquired by financial organizations trying to build super apps, is because they want your attention. They want your attention all the time. Obviously, there's the data elements in the background, but even ignoring the data elements themselves, they want to make sure that whenever the mood strikes for a food delivery, for something to be bought, whatever, or you remember that you owe your buddy money for dinner last night, they want you to be in that app. And ultimately, communicating with other people is one of the key things that engages us on our phones and on the web. So that's why communication is really critical to it. And if you look at some of the examples that I shared earlier from around the world, you'll notice that commerce plus communication or social really are the two things that came together that kind of bloomed into these super apps.
That's really, really interesting. We have two more questions that came in. So another question from Daniel says, only about 6% of iPhone owners actually use Apple Pay. I'm definitely one of them, but I was pretty surprised at that number. Does that suggest that it's harder to roll out these types of products?
Yeah, that's a really good question. I also use Apple Pay all the time, and I'm a big fan. And one of my former investors, one of my businesses, was actually the product manager who brought Apple Pay on board. One of the challenges they had at first, I don't really think it's an issue anymore, was where Apple Pay was accepted. And obviously, it's like anything, if you can't use it, then you're not going to think of it. And the less you can use it, the less you're going to think of it in the future. I don't actually know what the answer is for why the uptake has been so low, but I would guess the part of the answer is that we don't hang out in any sort of Apple applications while we are just hanging out. We're obviously hanging out on an Apple device. If you have Apple Pay, you have an iPhone. You're on an Apple device, but you don't think about it like spending time in the Apple app like you do when you're on Instagram or something like that. The other issue is that there's no peer-to-peer capabilities with Apple Pay right now. And peer-to-peer payments is often where these things start. So if we look at Venmo as a good example, but Venmo started as purely, me Venmoing my friend back for dinner or for rent or for whatever it was. And obviously now they have credit products, they have merchant products, et cetera, et cetera. And what they showed us, and my hypothesis would be similar for Apple Pay, is that because there's no way for you to interact with other people, the viral effect or the network effect of Apple Pay is just lower than that of and Venmo. That's a great question.
Awesome, thank you. And then the next one we have is, what role will valuation play? There's a debate over whether these companies have been oversold, with Affirm and Upstart down nearly 43% and more than 60%.
Yeah, this is such a good question. I literally have these debates with other investors and founders. I had one yesterday. I do think the valuations have gotten a little bit crazy, but part of that, especially if we look at DeFi and Web3, is connected to the uncertainty about the outcome of this market, right? Some people think that Web3 is purely a branding event, and it's the same thing that crypto was, a few months ago before we started using the term Web3. Some people think Web3 is the future of all of fintech. And like I said, some people think Web3 is literally the future of the entire internet. Ultimately, where you are, what you believe is going to impact valuations dramatically, because of course, valuations, part of the thing that goes into them is the potential outcome on the other side, right? So if I believe that crypto is going to take over all of finance, then I am probably willing to believe that the TAM, the addressable market that these companies are looking at, is X big, still pretty darn big if we think it's going to take over all of finance. But if I think it's literally going to take off all of commerce and the entire internet, then obviously the valuation I'm willing to pay is significantly larger, because my risk-adjusted rate of return, I think I messed up that saying, but my risk-adjusted return is much higher or much lower. I'm messing up this example, but the point is, the bigger market, you're willing to pay a much higher valuation than you're on a smaller market. And the reason people disagree is exactly the point that I made, which is that we have legitimate disagreement on how big the Web3 space is going to get. I say just one other thought too. There's also some confusion. I was talking to an entrepreneur yesterday who's simultaneously doing an equity raise from venture, as well as an initial coin offering to raise money through a coin. And it was really interesting to think about essentially why he was not doing all of them through one or the other. And it's interesting to think about the fact that it seems to me that the equity investor, like someone like myself, is really only looking at the enterprise value that this company can one day reach, and I'm making an investment decision based on that assumption. Whereas a coin investor is also factoring in just the demand for that specific coin / demand for all coins in the market. So it's, again, when you're looking at buying one versus the others, there are probably different considerations you have in mind, which is ultimately why companies are getting these kind of wacky valuations, especially when they mix the two mediums together.
Gotcha. Alrighty, well, we do have one final question for you. From Michael, you haven't mentioned network effects. Is this really any chance for startups to inspire a super app when Facebook, Google, and Amazon and others are so strong?
Yeah, so network effects, and I think aggregation theory in some ways swallows at least parts of network effect into that. But I think network effects are incredibly important. I mean, and going back to the Venmo example, right? The fact that if I wanted to send you money, I had to send you the Venmo app to get you to join the app, I think is a very powerful force that essentially got adoption supercharged. And that's why these super apps are really interesting, because they really try to build in all the effects. It's network effect, it's viral spread, it's all these things that they were trying to piggyback on. And again, if we look at the Asian super apps, they have very much successfully done that. So I think network effect is incredibly important, and also trust, which is an element of network effect. But ultimately, right, like before we're going to put money anywhere, before we're going to trust someone with our resources, there has to be a whole lot of trust built up. And one of the best ways to build trust is to know that people you already trust that company, trust that entity, et cetera. Yeah, so I think network effect will be a vital part of this.
Awesome. Well, thank you for all of that. Thank you for taking the time to talk to us and answer these questions. And I think with that, I'm going to go ahead and pass it back to Ashley.
All right, everybody, that's all for today. Thank you all for joining us, and a big thank you to Gilad for sharing his wisdom with the group. As a reminder, next Friday at noon, we'll be hearing from Hope Cochran and Elisa LaCava from Madrona Venture Group, who will present how to raise venture capital as a fintech startup. Sign up for that, and we'll see you all next week.